Is surprise. I told you I was going to be surprising you guys, surprising you traders every now and then with slightly more frequent Q&A sessions. I eventually, traders, want to get the Q&A sessions to be a regular feature on this channel every single week. So that this way, as my daily videos come out and your questions accumulate, we can sort of dissipate many of those questions every single week, so that your questions can sort of evolve in a very natural process. So I'd like to eventually get to that. And that is one of the things on my bucket list for the year 2022. Now, traders, I do hope that many of you have been enjoying the content on this channel. There's a great deal of work, traders, that goes into producing quality educational and informative content for you every single day. It literally takes up hours and hours of my team's time to put the content out. But it is something that is very close and passionate to my heart. I made a promise a very long time ago, that if I were to ever make it in my chosen path, in my chosen profession, that I would do my best to be a beacon of light on the educational front, because when I started in this business, there were no teachers, there were no mentors, there were no seminars or events to attend. I started in a world where you either had contacts that ran deep enough and important enough to land very specialized jobs on Wall Street, and you learned from professional organizations, or you did the much more difficult route called trial and error. Much more difficult because it's very expensive and the odds of failure are even higher. So I was greatly frustrated by this dearth of material, this lack of information. And when I started in this industry, the culture was very different. It wasn't a culture that was rooted in the concept of sharing. Sharing was not a very popular concept when I started in the early 1980s. The word proprietary was the word that I guess encapsulated most of the mindset back then, that you held things secret, that groups of traders did not share what they were doing, especially if they were extraordinarily successful at what they were doing. Secrets were extraordinarily valuable. And it's not until the advent of the internet and obviously the computerization of the world, the digitization of markets, that revolution started to take on, that the world became more open as to being more centralized. We're still actually going through that process of decentralizing financial markets, and completely digitizing markets, because it's the open nature that the world is moving toward. These platforms are moving toward more open scenarios, decentralized scenarios. And as that movement continues to flourish and mature, you get this more sharing and open, activities regarding knowledge and information. So I'm very happy to be in a position of being able to realize the dream that I had many years ago, which was to leave behind a legacy, a body of work that I believe will serve as a beneficial item for those just like me, all the way back in the early 1980s, who found a passion with financial markets and understanding or arriving at financial truth for themselves. I'm hoping that my work can serve as some foundation. And so it takes a lot of work to do it, but I'm happy to do it, and I hope you've been enjoying the content as well. What I'd like to do is take a number of your questions here. I don't want to go off on a big long theme talk because that sort of takes away from the whole purpose of coming together with you today. Just to take a number of your questions. I'm not quite sure how long I'm going to be able to go today, but I do want to take some of them. So I'm glad to have you here. I see that many of you are from all over the world here. We always have an international audience. And if you want to tell me where you're coming from, that's perfectly fine. Also, I'll do my best to sort of read some of the questions that come through. So, yes, I appreciate that from Z-Man1969, who's saying, Oliver, I can't express enough to you how much I appreciate everything you do for us. And it's those comments that sort of keep me motivated and fired up to go. So, guys, I do want you to understand that I do my best to read the comments that you place here. And all of your comments that are very encouraging regarding the content and the information, they do help me. So by all means, continue to make those comments, please. All right. Tevfik Khaled is saying, thank you for the training videos. I see that your method works best on the 2-minute time frame. Can it be used on the 1 hour or the 1 day time frame as well? Now, before I delve into this question, traders, please understand that as I start to answer your questions, it's going to be important that if you really want to try to get your question answered, you might have to ask it rather regularly, because as I'm answering your questions, I'm not looking at your comments. So I will not be scrolling back. So you might have to just regularly put that question out into the comments. So this person's this trader of mine is asking, do the tactics that I teach on a 2-minute time frame, are those tactics, the methods, the strategies, are they applicable in other time frames? And the answer is yes, absolutely yes. And I think it's important to understand something regarding this. Number one, the truth is universal, and there is a truth in financial markets like there's a truth in life in general, okay? And when you arrive at a truth in financial markets, that truth is ubiquitous, that truth is universal, and time frames don't alter that truth. So whatever you find to be true in the 2-minute time frame must be true in all time frames, 5-minute, 1 hour, 1 day, 1 week, 1 year, because the change of a time frame is not an alteration of the truth, of reality. The truth is real. Your time frame is a function of your convenience. The time frame change occurs only on your computer, only on your screen. Your time frame is not altering the market's truth. And so this question comes from, in a sense, an innocent lack of understanding that you're simply manipulating how you choose to see the truth. So, for instance, if I were to draw a picture of an apple and I were to if I were to draw lines down that picture of the apple, if I draw 15 lines across the apple, I'm now looking at the apple via 15 parts. That the lines that I draw on top of the picture of the apple doesn't change the reality of the apple. Do you understand? If I decide instead of 15 lines to draw 5 lines, so now I'm looking at my picture of the apple with 5 lines on top of it. The 5 lines are my choice. The 15 lines on top of the apple are my choice. Neither of those choices changes the reality that behind the lines are the apple. And so when your tactics and your techniques are based on the market's truth, you should be able to use them universally across time frames. And I will also say this, that if you find that you're using something on one time frame that seems to break down or have less relevance on another time frame, then you have not found a truth. You might have found an anomaly, but you've not found a universal truth. And the soundest of all trading tactics are based on the market's truths. These truths stand to be universal. These truths stand the test of time. These truths are often based on not the market themselves, but more directly on human nature. Because as I've preached to you over and over again, markets don't have lives of themselves. The market doesn't have a life of its own. The market's life is derived from the collective lives of its participants. Their lives, the lives of the participants, are ruled by dominant emotions. And so if your tactics are based on the core mover of markets, which is fear, greed, and uncertainty, and where those things intersect in the markets, then you have a universal approach to the markets, okay? So yes, everything I teach you is universal across all time frames and across all markets, because just because you put a stock in the hands of human beings that are driven by fear, greed, and uncertainty, and you change it from a stock to a cryptocurrency or an option or a futures contract, just because you change the item in the hands of that human being doesn't mean that the human being becomes driven by something different. Oh, wait a minute. I'm fearful and greedy with stocks, but when you put an options contract in my hands, I suddenly stop being greedy and fearful. No, it doesn't work that way. So when you have something really sound, and what I do teach you is very sound, it's going to be applicable across all time frames and all markets. All right. Now, I've answered that question a little more thoroughly than I plan to answer most questions, but because I get it so often, right, I wanted to do a very thorough response to that, and I'm going to try to cut this Q&A, this specific one, out as a separate item and have it hang into the internet world all by itself. But thanks again for answering that question. It looks as though I'm getting some pauses in my live feed. I hope everything is okay. Am I losing frames? Just a few. I think I'm okay. All right. Abhinav is asking, Oliver, how often do you swing trade? Interesting. Now, swing trading is a specific style of market play that I actually coined. A lot of people don't know this history. So all the way back in 1992, I applied this unique and very, very different approach to the markets as opposed to the vast majority of Wall Street. And this style of market play started to gain some recognition through my work and through my popularity in the trading industry. And so firms began to invite me to speak to their groups of traders. I began to be invited on certain financial programs to talk about this style that was starting to pick up steam on Wall Street. I gave this style of market play in an interview the name swing trading, and it comes from taking advantage of the market's one-legged swings. So the market's trends are made up of a string of multiple swings. And so to zero in on one of the market's legs or one of the market's multi-bar swings is the style called swing trading. And I coined this term, which became popular all the way back in 1992. Now, if you Google right now, Oliver Velez swing trading, all right, you'll probably see some of the work I did all the way back in the beginning of the 1990s and in the mid 1990s with this particular style. I was termed Mr. Swing Trading back in the 1990s. Now, that's to give you a little backdrop regarding my history with swing trading. and how I came up with the term swing trading. In fact, my video or my live talk on swing trading all the way back in the mid 1995s got made into a VHS video. That VHS video became the world's most sold VH video on trading. And I believe that record still stands today. So I have the most popular video, which ultimately became a book on the topic of swing trading. And I did that all the way back in the mid 1990s. Now, the question is, how often do I swing trade today? Not as often as I apply the other two styles of trading, which sit on the opposite ends of swing trading. So swing trading sort of sits in the middle of micro trading or day trading and more core trading or macro trading investing. All right. So if we take the styles and drop them into three broad categories, and there are derivatives of each style, by the way. But if we take the three broad categories of styles and we say short term, long term, and what sits in the middle is swing term or swing trading. All right. And so I micro trade or day trade, and I core trade or macro trade far more than I swing trade today. But back in the late 1980s, all the way into, I would say, the late 1990s, my primary approach to the market was swing trading. All right. So good question, by the way, guys. Good question. All right. Just want to make sure everything is okay. All right. 8520456. Nice name. How important is the direction of the spiders or the S&P 500 or the S&P 100? How important is the S&P's P when you're deciding to put on a trade? Interesting question. It depends on the trader, and it depends on your approach to your trading. I, for one, am not a big relier on what the general overall index or general market is doing. I tend to be more of a bottoms up trader, which means that I zero in on specific stocks that are on my list that are demonstrating certain events at certain locations. And irrespective of what the market is doing, if the event is powerful enough and it is at the right location, I will give that more importance than what the overall market is doing, because I'm trading a short enough time frame where I can still take a trade against the overall market, and the overall market is right and my trade is right. All right. And if I stretch that time out long enough, maybe not so much, but anything can happen over an 8-minute period, over a 12-minute period. All right. Now, if I were to stretch that out over a 12-day period, then the longer my holding time frame, the more I want to actually rely on overall index or overall market direction. I would need my trades to be a lot more aligned with the overall wins, as it were. But when I shrink the time frame, it's not as important, because a trade can go against the overall market in a short period of time frame a lot more regularly than it can go against the river or against the market in a bigger time frame. And so it depends on your style. When I'm micro trading, not so much. When I am macro trading, yes, absolutely, it's important. You know, what's the overall wind doing? Is it blowing this way? Is it blowing that way? Is the river going downstream? Is the river going upstream? Do you understand? And so that becomes a lot more important. So it depends on the trader. It depends on the style of trade that's going on at the specific time. All right. So I hope I've answered that properly. All right. Should we never sell Bitcoin in our life? Okay. This question, or my response, or both, is very nuanced. It is my belief that you should not be so quick to sell what is sound into what is less sound. That just doesn't make sense. You don't sell what is strong and change what is strong for what is weak. All right? That doesn't make sense. So, for instance, someone in Venezuela, where their currency has collapsed, the Venezuelan bolivar, right? That currency has collapsed. You would never find someone in Venezuela who says, wait a minute, let me take my dollars and change them back into bolivars because I think the dollar is short-term overbought here. Never in a million years will a Venezuelan living in Venezuela change dollars back into bolivars. For what? It's ridiculous. Okay? So if we assume that Bitcoin is one of, if not the most sound forms of money in existence today, to change it or to sell it back into a weaker asset, a weaker form of money, doesn't really make sense in a lot of different scenarios. So generally speaking, no, I am not a seller of Bitcoin. I am a hedger of Bitcoin when I believe it's overbought and due for a pullback based on the view of Bitcoin through the eyes of the US dollar. Okay, I am a hedger. If I were to need extra fiat, I would use that pristine asset as collateral to get a low interest loan. That's being smart. But let me just tell you this. The wealthy in this world do not sell sound assets. I'm going to repeat this. The wealthy in this world, when they get ownership of sound, solid assets, they don't sell, especially for weaker assets. And so I am generally not a seller. I have never, that's not true. Once I realized what Bitcoin was, I've never sold a Satoshi. I have no plans of selling a single Satoshi. I have plans of borrowing against those Satoshis at some point in the future. I have plans of hedging myself to mitigate downside risk, but I have no plans of selling whatsoever. Now, that's me. I can't tell you what to do. All right. If I would just encourage that if you did consider selling, make sure it's something so incredibly life-changingly important, all right, that it's worth it for you. Your dream home, saving a loved one by paying for this expensive operation. It's gotta be something life-changing for you, in my opinion. All right. So I hope I've answered that. All right. Nav is asking, Oliver, what are your thoughts on using trailing stops for every trade as a trading plan and rule? I trade Ethereum and it moves quickly and trends in both directions. Trailing stops are one of the 7 important components of a trade. But one has to know when to apply trailing stops. You see, to just automatically apply a trailing stop from the moment you enter a trade until you exit a trade is not proper trading. In fact, that's a very novice-like approach to trading. Every moment of a trade does not call for you to have a trailing stop. There are specific scenarios that might develop in the trade that call for you to have a stop adjustment and to trail from that stop adjustment. But one of the big mistakes I find that many novice traders make is to, number one, adjust their original stop too quickly. So as soon as the stock starts moving in the direction, boom, they're tightening up that stop. That's usually an error. Okay. I find that another error is to tighten when they do make an adjustment or start to trail. The trail is too tight. So the trader is literally begging to be taken out of the trade. All right. That's a common error. Okay. And the other common error, which I told you, is to apply a trailing stop when you're not supposed to apply a trailing stop. I find that traders are adjusting stops when they have nothing to protect. If you've entered a trade and don't yet have anything to protect, what are you adjusting for? And then if you have to adjust when you have an adequate amount not to protect. And so you have to define for yourself what's that adequate amount. Is it $5? No, that's too small. Is it $500? So you have to have certain elements of your plan that says things like this. Look, once I hit $500 in profits, I'm giving you an example. Once I hit $500 in profits, I will not go home with less than 200. I'm willing to risk 300 of the 500, but I am not any longer willing to go back to zero. Whether that's 500, where you make that adjustment in your plan, whether maybe it's 300. After 300, I've got 100 locked in. I'll sacrifice 2, but I won't lose 1. So these are specific examples. And then you need multiple examples. So let's say, okay, once I hit 300, I always go home with a minimum of 100. But if I get to 500, which is goal number 2, now I will not lose 200. When I go to 600, now I won't lose 300. When I go to 800, now I won't lose 500. Now, this is a proper way to mechanize your stop adjustments. What you don't want to do is to randomly do it based on your feelings, your emotions, and your thoughts in the heat of the moment, because that can't produce consistency. You're always going to think differently. You're always going to feel differently. You're always going to believe differently. There are too many moving factors that can influence you one way this time, another way another time. And so in order to be consistent, which is the key to success in this business, consistency, your approach has to be consistently applied across every single trade. And so to mechanize your trailing stop approaches, you need more than one. I just gave you one example, right? You need more than one. For instance, in my trading program, my traders have 7 trailing stop approaches, okay? But you need more than one, okay, because there are more than one scenario. And so we have a trailing stops method for each one of the 7 scenarios that call for you to make an adjustment. And so it's that detail, guys. How many people do you know that have these things already mapped out? You see, the example I gave you is already mapped out before you even enter a trade. When I reach 300, I protect 100. When I reach 500, I protect 200. When I reach 600, I protect 300. When I reach 800, I protect 5. You haven't even entered a trade, but that's written down already. That's a law for you. And so the best traders have every trading question answered before the trade. That trailing stop method is set before the trade. It's the traders that are making decisions off the cuff in the heat of the moment, when they're emotional, when they're fearful, when they're greedy, when they're anxious, when they're uncertain, when they've got all this data coming at them all at once, conflicting things. You can't be consistent if you don't have things already planned out in that scenario. All right. All right. Good questions, guys. Good questions. All right. Thanks, Oliver. Makes a lot of sense. Great. Okay. AA is saying, so glad for the stream. Are you familiar with algorithmic trading approach? Can you explain? Yes. At one point, guys, I had 14 different algorithmic trading programs operating literally 24 hours a day. All right. And I did this for years, up until not that long ago, actually. All right. So I don't have 14 now, but I at one point at the peak had 14 of these things operating. All right. Some in the futures market, some in the equities markets, some in the futures markets, some in the equities markets, and some of the Forex markets. And the futures and the Forex were operational 24 hours a day. And of course, during market hours, my algos in the equity market were operational. And so I would say that I'm quite familiar. And I started algorithmic trading back in 2001 after the dot-com bubble collapse. And so I'm very familiar with it. Now, one of the key questions that I get all the time is, has algorithmic trading made human short-term oriented trading more difficult? In some ways, yes, and in some ways, no. And will algorithmic trading eventually make human-based trading obsolete? The answer is absolutely no. I think it should never be forgotten that human beings are still the creators of these things. So it's just an extension of the human being. It takes the human's actions and makes those actions more consistent. So they're set in stone. Whereas if the human might change and adjust, the algorithm cannot change and adjust. Now that gives the algo an advantage, but also the advantage of the algo is also the algorithm's disadvantage. You see, sometimes life and the market is nothing more than a microcosmic version of life, right? So whatever's true in life is true in the market as well. They're inextricably intertwined. Never forget that. So listen to me carefully. The very fact that the algorithm cannot change is its plus and its negative. It's its crowning jewel and its Achilles heel. Now, in life, there are times when you have to break your rule. I remember my mother taught me, I used to come home from school alone, all right? And she would always say, Oliver, listen, you cross at the green, not in between. You go all the way to the corner, you wait for the light to be green, and then you cross. You don't take a shortcut and cross in between the corners. Do not cross in between the traffic lights, Oliver. So you cross at the green, not in between. All right. She was so frightened that I was going to get hit by a car. All right. Because I was very rambunctious and active. And that's a great rule, especially for kids. It's a great rule for adults as well, but certainly for kids. Waiting, going all the way to the corner, waiting for the light to be green, and then crossing the street. Okay? But if there's an emergency where going all the way down to the corner, waiting for the light to turn green, then crossing and then coming all the way back up the block is going to take you too much time, that you need a split-second reaction, or you need because this is an emergency, you're going to have to break that rule, right? There was a scenario where I was coming home from school one day, and a mother was actually had her baby on the sidewalk in a carriage, okay? And she was taking groceries out of the trunk and walking them up a small flight of stairs while the baby was on the side of the sidewalk, just like 3 or 4 steps, not very far. She wasn't being irresponsible by any means. But what she forgot to do was put the lock on the carriage's wheels. And I was coming home from school and I saw the baby's carriage start to creep down. There was a little slope in the sidewalk, start to started to roll down the sidewalk, and it was heading toward the street. Okay, ongoing traffic. The mother was up the stairs putting the packages down. I looked both ways, all right, made sure it was clear. I darted across the street, stopped the carriage just in time, put the lock on. She profusely thanked me. In fact, she took me home and waited for my mom to come home to tell me that I saved her baby's life. All right. Now, I don't know if the baby would have died or anything like that, but that scenario was life dictating that I should not follow my rule. Now, I know that may be a roundabout way to come back to trading here, but I will tell you that the algorithm that my mother gave me, had I applied it, would have been detrimental. It's not that the algorithmic rule of going to the corner and crossing at the green was incorrect. That's correct most of the time. But what about the times it's not correct? And so this is where algorithmic trading fails. And so just like you have your strengths, you have your weaknesses. Algorithms, every single one has its strengths and has its weaknesses. So because of this, it's just another market participant. That would just be like saying, will good traders make bad traders obsolete? No. Will algorithms make human trading obsolete? No. Human traders have their benefits and their Achilles heels. Algorithms have their benefits and their Achilles heels. It's nothing more than a mechanized person. It's another market participant. And so I just think that traders give too much importance to these things. All right. And you want to be careful not to blame your poor trading on things like algorithms, on things. I hear traders all the way saying the market makers are manipulating the market. And I'm like, listen, the market makers are the least of your worries. You need to stop losing more than you say you're going to lose. That's the first thing. All right. Market makers have nothing to do with that. All right. I hear so many traders talking about market makers, talking about fees and spreads and my broker, my internet connection, my keyboard, You will always be your number one problem. Right? Everything else is secondary. All right. Okay. Thanks, Oliver. The real OG of trading. I appreciate that. I love when you connect trading with real life and experiences you had. Yeah. And, to me, that's when you have grasped something deeper, that it's no longer just a vague conceptual item. When you can connect it to things in your life, things that have happened in your life, past experiences, then that's the key sign that it's beyond the point of being a concept for you, that it's connecting with your own experience. And I will tell you that we are, not to wax too philosophical here, but who are we other than a collection of experiences with a name on that collection? I mean, that's really what we are, right? You are nothing more than all of your experiences bunched together, and you have a name on that group of experiences called John or called Oliver. So we put a name on this collection of experiences. That's it. And everybody's collection of experiences are different. That's what makes everybody unique and different. It's because your experiences can't be the same. And I'm just calling John, I'm naming the collection of experiences here, John. And this collection of experiences is called, let me grab a name, Alex S. All right. This collection of experiences is called Julie. All we are is a collection of experiences. And this is why I'm constantly telling you, my traders, that if you change your experiences, you change who you are. You have to watch the experiences you allow yourself to have. Okay? You give a child enough bad experiences and watch the end product. That's not going to be a great end product. You give a child a string of amazing experiences, and that end product is going to be amazing. We're nothing more than the product of our own experiences. We're nothing more than the collection of our experiences. And this is a beautiful thing because it makes you realize that you, as a trader, you may not like who you are as a trader today. And who you are as a trader today is a direct result of all of the experiences you've had as a trader up until this point. But you can change that at any moment going forward. Change your experiences, change your life. Change your experiences today, change the end result tomorrow. It's all about building the right experiences. Now, if you don't know what the right experiences are, you have a problem. That's where a mentor comes in. That's where a program like mine comes in. That's where training comes in. But if, most people are out there, they don't even know what a good experience is versus a bad experience. And so they can't even start building the right experiences for themselves. All right, cool. All right, guys, love these. Great questions, by the way. I love it. I love it. I love it. I love it. Future of Tesla the next 10 years, my opinion, sir. I think a very powerful future. It's still in that price discovery phase where you have so many different factions of the market with differing opinions. You understand? So you have people that think that it's just a bubble. Tesla's a bubble. You have still people think that Tesla's a fad. You have still people think that no company can be run by a guy like that has long-term success, Elon Musk. You have people that don't believe in the whole movement of electronic vehicles still. You have people that have not recognized that Tesla's like 19 different companies and not just one company. So you have all of these differing opinions, which means that Tesla is still so early in its phase of development as a full-fledged powerhouse that it hasn't even found price discovery. And that's why it will be volatile for a while. The same thing applies to Bitcoin, where you have all these differing opinions of what it is. Some people think it has zero value. Some people think that, 48,000 is stupidly high. It's overbought. Some people think that 48,000 is nothing, that this coin is $50 million a coin in the future. So you have all of these differing views. Price discovery hasn't been found like it has, let's say now in Amazon or Apple or Microsoft. And so the volatility is a lot less with those items because you have the majority of people recognize value there, recognize that there's intrinsic value, that there is power there, that there's longevity there. You understand? And so initially, a growing asset does not have price discovery. Amazon crashed every single year for 20 years. I mean, well, maybe not 20 years, 15 years. I mean, I lived through it. All right. Apple in the beginning, volatile. Microsoft in the beginning, very volatile. All right. So my point is that Tesla is likely to continue to be volatile, which I think is a good thing, which is an indication that you're still in the early adoption phase of what Tesla is all about. I believe that most people don't recognize that Tesla is not just an electric car company. It's like 19 different companies that are all in futuristic spaces, powerful. And so I think its future is extraordinarily bright, despite its meteoric price rise. So how do you take advantage of assets like that? You take advantage of every major crash. Okay. You take advantage of every major crash. That's what I did with Amazon, starting from $7.50 all the way till now. Okay. When you believe that you have something that is viable for the future, then crashes become a good thing. They're psychologically difficult to live through, but you've got to get over that hump if you're ever going to be this wealth building market participant. You've got to be able to turn what hurts most people into your gift. Do you understand? All right. All right. Sir, Anson is asking, sir, what is your take on the current market condition situation? Can we expect another .com bubble? Look, I believe, first of all, let me just say, I really don't know. And if anyone tells you they know, they're not being intellectually honest with you. And I'll tell you the reason. Because we're in uncharted territory. Most of my entire financial career, which spans almost 40 years, okay, I just celebrated my 35th professional trading anniversary, December 6th. All right, December 6th, my trading career is 35 years old. All right. So my point is this, that throughout my entire career, I've never lived through this. I've never lived through the current monetary policy that's being implemented today. In the last 18 months, the US in particular has printed 40% of the entire world's dollar supply. So think about this. The dollar as we know it has been in existence since 1913. And it has been printed every single year since 1913. So more dollars have come into existence since 1913. In the last 18 months, 40% of the entire dollar supply was printed inside of 2 years. Are you kidding me? We've never lived through that. Now, guys, when you increase the money supply by 40%, and you continue to do so, you have to realize that products and services have not increased by 40%. And so now you have more dollars chasing fewer products and services, which causes prices to rise, right? Now, particularly, an increase in money supply causes assets to rise. Why? Because the increase in money supply causes a devaluation of the money. Do you understand? So every new dollar makes all the existing dollars worth less than they were before that new dollar came into existence. It's simple economics 101. Higher supply, lower valuation of the item, right? So the dollar has been debased in the last 18 months, 2 years, 40%. All right. So when you get dollars, if those dollars are being debased, which means that in a short period of time, a dollar is 98 cents, and then it's 95 cents, and then it's 90 cents, you have to, smart people, get dollars and switch them immediately into something hard. The dollar is considered soft as it's devaluing. So you have to switch a soft asset into a hard asset that's not devaluing itself. Okay? And so this causes asset prices to go up because smart people who gain access to dollars either through debt or through earnings, they immediately switch the dollars into hard assets. All right? Those prices of the hard assets, because more dollars are chasing hard assets, the prices of hard assets go up. Okay. So we have just never lived through this. So what are hard assets? Bitcoin's a hard asset. Gold's a hard asset. Real estate's a hard asset. Stocks are harder than currency. And this is what a lot of people don't understand. Stocks fall into the harder asset category than money. Stocks are harder today than bonds. Stocks are harder today than dollars. Then stocks are not as hard as gold. Stocks are not as hard as Bitcoin, but they are hard. Why? Because their supply is limited. Okay. So you might have a lot of shares. Like, for instance, Apple has 16 billion shares outstanding. Now think about that. Bitcoin has a maximum 21 million shares. Apple already has 16 billion shares out there, but at least it's finite. Apple's not printing trillions of shares every single year. That's what the dollar's doing. So if Apple's not printing more shares in the trillions every year, but the dollar's printing trillions of new dollars every single month, then whenever you get dollars, if you put it into Apple, you're actually safer in Apple. And so what I'm saying is that what this does is artificially keeps asset prices high. And as long as those dollars are being printed like that, asset prices are not coming down. And in fact, if the smart people are using the system to generate more dollars, cheap dollars, because money's free today for the most part, if you are privileged, not if you're not privileged. If you're privileged, you can borrow money for practically zero and move the money you got for free into something like Apple, which is harder than the money you received. And so as long as we're in this prolific money printing environment, I don't see major cracks in equities. How? Some of that's going to go to Bitcoin. Some of that's going to go to gold. I don't know why. I mean, because I think gold is broken in the new digital era. All right. It served its purpose in an analog era, but we've left an analog world and has moved into a digital world. And so digital gold is replacing analog gold. But that's another topic. So what I'm saying is that I just can't see this. I can't see where there's still limited Apple shares, but there's unlimited dollars being printed. Those dollars are going to find their way into what is limited, because if they don't, a dollar becomes 90 cents, becomes 80 cents, becomes 70 cents. So it almost forces, there are two types of people in this world. There are those who are basically consumers that live off of the dollar. And what I mean by the dollar is fiat currency. It could be the peso, it could be the yen, it could be the renminbi, it can be, the euro, whatever. I'm using dollar as a general term for fiat currency. There are those who live off of fiat currency and are consumers for the most part. And then there are those who are investors. So the world can be pretty much divided into those two groups of people. There are other divisions, but I'm just broadly speaking, there are consumers who live off of fiat currency, and then there are investors. The investors will take dollars and invest those dollars into what is limited. Apple's limited, 16 billion shares, and they're not printing more, not at the moment. Microsoft's limited shares. They're not printing more. They're printing more dollars. So I have to take the dollars and put it into something that's not being printed more. That preserves the value of the value that's declining here is preserved by placing it here. Okay. And so smart investors are not only just earning dollars and making the switch, but they're borrowing dollars to make the switch. Those who live off of currencies, earn currency, and just live off of currency, they're just consumers. So they're being hit by two things. Number one, they're forced, because the dollar that they earn today is less tomorrow. They are forced to have a high time preference, which means that they're forced to buy something with it today, because today it's $1, but tomorrow it's 90 cents. So if you wait too long, it's 80 cents. And if you wait longer, it's 60 cents. And if you wait longer, it's 50 cents. And so this forces society to become consumers. So consumerism de-incentivizes savings. So it starts to impoverish society, right? The part of society who's not in the investment camp, the part of society who's just who's just a liver off of currency, they're forced to get currency and spend it. They're de-incentivized to save it because it's less and less if you hold on to it too long. In addition to that, so they're hit by both ways. They're hit by no savings. It's stupid to save in this environment. They don't invest. And if they do save and do the stupid thing, their dollars get less and less and less and less anyway. So they're getting rid of their potential wealth by being a consumer. And if they're not a consumer, they're holding on to their fiat and giving up their wealth as well. So it's a destructive trend for the masses, for those who are not investors in hard assets. And the only protection is to be an investor in hard assets today. And equities are harder than dollars. So I know it's a long way to answer that question, but it's something that touches my heart so deeply today. And I try to spread this message as much as I possibly can, because everywhere you look on Instagram and on the social media networks, the whole message is consumerism. It's to be a consumer. Everybody's got expensive purses and shoes and showing you private jets and cars that cost $500,000 to $1 million. This is promoting consumerism, and it's the wrong thing, especially today. All right. What should be taught is the switch of fiat currency into hard assets, and people should know what the hard assets are. All right. Sorry, guys. Am I still bullish on Bitcoin? You can't tell? Of course, forever. Oliver, this is a nice surprise. So good to see you. Good to see you too, guys. Good to see you. All right. SMGY is SMG is asking, why did you choose to trade stocks and not other assets like futures, CFDs, etc.? If you had to choose one thing to be profitable with your system, what would it be? All right. So listen, I became fascinated with markets all the way back in the early 1980s. In fact, I placed my first trade in March of 1981. Okay. So pioneer in the space long term. When I started trading, equities were not the popular thing. It was bonds. We lived in a bond-oriented world. In fact, equities were pretty much dead. So if you went to school at that time and you graduated and wanted to get a job on Wall Street, you wanted to get a job on the bond desk, not the equity desk. All right. If you got relegated to the equity desk, people regarded you as being pretty much at the lowest part of the totem pole. They would assume that either, you barely made the cut to get hired by the firm, or your grades were poor, or you just messed up in your interview and they just put you in the black hole called equities. Okay, that's how offbeat it was. And if you know anything about the history of equities, or if you were around back then, you'll realize that during the 70s, the equity market the Dow was stuck below 1,000. So it would vacillate between 500 and 1,000. But people at that time thought that equities had an incapability of breaking above 1,000. And so they felt that the market was trapped. And so you still had this general idea that bonds are for gentlemen and equities are for Okay. And this was exasperated by, to a certain extent, this is what kind of brought about, to a certain extent, the whole junk bond movement that happened in the 80s. But it was the junk bond movement that actually brought equity trading back into vogue, because the junk bond movement allowed anybody who was connected to gain financing to basically start taking over these companies, raiding these companies. They were called corporate raiders back in the 80s. And the corporate raiding that went on caused stock prices to jump exponentially. Now remember, we were coming off of a decade of the 70s where stocks didn't jump. There was no exponential movement in the markets. The Dow couldn't break above 1,000. You just didn't have movement. You didn't have volatility that way. But the junk bond movement brought volatility back to the equity markets. It brought exponential moves to these stocks. And so equity trading started to become in vogue again. People started to become interested in taking advantage of stocks that would double overnight. And that's what brought equities back. This is what opened the door for me to get my first job on Wall Street on December 6th of 1986. It was in the heat of this equity and junk bond corporate raider movement that was going on. All right. And so I would say that modern day equity trading came to life in the early to mid 1980s. And that's when I started. And so it was an exciting time to be in the equity markets. For the first time in a decade or so, equities were alive again. All right. And I wasn't born when they were alive before. So I started at a great time for equities. And it was hot. It was cool. It was amazing, right? And so I'm glad I started with equities. Now, you have to also remember that Forex trading was not available to your individual. That was a market that was predominantly for banks and really banks and countries for the most part. Federal Reserve banks and countries, they traded Forex. Forex didn't become accessible to your average individual for decades later. Okay. Options market was still very young. Remember, the options market came into existence in the early 1970s. I started in the 80s. That's a baby market. And that was considered, leave that for the market makers and the professionals for the most part. Okay. For the institutional professionals. And so, you really had two predominant choices when I started: equities and bonds. I didn't have the connections initially to I didn't have the connections to infiltrate Wall Street at the beginning. Otherwise, I think I probably would have winded up a bond trader. All right. But I'm very glad that my path took the route that it took, because I believe that just trading equities is the best. I think that's the best market in the world for short-term oriented trading. I'm biased, I'll admit that, but for short-term oriented trading, I think that the worst market in the world for short-term oriented trading is the cryptocurrency market today. I just think that's more gambling. Not that, I believe in the market, don't get me wrong. I just believe that short-term oriented trading is just more of a gambling thing today. It has to become more mature to become a good short-term oriented trading thing. And yes, you can win big if you catch things right, but there's still price discovery going on there. And so that's like trading Amazon back in the early 2000s, late 1990s. You got murdered there. You would hit it big, but you would get murdered as well. So the best thing to do, long-term approach, is more when something is still in price discovery mode. It's better to hold on to it if you have faith in it versus to trade it back and forth. All right. Okay, Mark Edwards is saying, Oliver, when you say buy 1 cent above the previous small bar, do you mean submitting a limit order ahead of the trade set at the price? No, you don't have to. You don't set a buy stop order. That's what you're saying. You don't set up. When I say buy 1 penny above, I mean sit there and wait. Look at your level 2 a bit. Look at the bar on the chart. Look at the level 2. You know where the high of the bar, let's say, is $40. When your level 2 on the ask side gets to 40, get ready to press the button. When you see trades going off at 40.01, boom, 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 like that. All right. Now, if you're swing trading and your time is stretched out a little bit and you don't have the ability to be with the market every moment, then yes, you can place a buy stop order above the bar's high by 1 penny or so and just let the market, let your brokerage firm or clearing firm or your trading platform try to automatically get you in. But I've just always been skeptical of things like that. I like to place my own orders. And when you're short-term oriented trading, you just have that privilege. Okay. Oliver, so Oil Money is asking, Oliver, what's your thoughts on Peter Brandt? I don't know who he is. Sorry. Maybe I do. I just don't recognize the name right now. Calling the current Bitcoin pattern the double top. I understand it. I understand it. But listen, Bitcoin is very difficult to chart from traditional technical analysis concepts right now. It won't be forever. It won't be difficult forever, but it is difficult now because of what I explained to you. Number one, it's still in price discovery mode. This is why Bitcoin often blows modern day technical analysis concepts out of the water and surprises everybody. All right. Because in price discovery mode, the traditional things that form these technical patterns are not there as powerfully. In addition to that, Bitcoin is truly experiencing a supply crisis, and you can't chart a supply crisis. All right, in a way. So traditional technical analysis things applied to Bitcoin. I'm not going to say they have zero relevance, but the relevance is a lot less than, let's say, an Apple, who's got price discovery. Its price is stabilized by price discovery. You have a balance of buyers and sellers. You have a more ubiquitous idea or belief that Apple has value. When something is seeking price discovery, you'll have violent moves on both sides that destroy common technical analysis techniques that have been built on things that have already discovered their price, have already achieved price discovery. And so I pay a lot less attention. And guys, look, I believe I can chart with the best of them. Been doing it for over 3 decades. I believe I can chart with the best of them. I can hold my own with anyone out there as far as a technical analysis. And I will tell you, as being, in my opinion, one of the world's best, my opinion, all right? I hope that doesn't offend anybody. I will tell you that I pay less attention to those things. And I believe I can chart better than most. All right? So I'm not buying it. I'm not buying it. Okay. All right. Wolf of London Trader. I trade $40 to $80 stocks. How many cents do you let the stock run before deciding to put in a break even? Many thanks. All right, that's a good question. I believe that I teach my traders that you should not be, with my style of a market play, I don't want them taking profits less than 30 cents. Okay. There is a big problem you start to get into when you start to take really micro gains of less than 30 cents. So 30 cents is my absolute minimum. But 30 cents really applies to stocks that are sort of under $60. When you get above $60, I would bump that to 50 cents. You understand? So if you're above 100, I'd bump, if you're above 120, I'd actually bump that a little bit higher. Maybe now you're in the 60-cent category. And if you're 150 and above, I'd bump that to a 75-cent, 80-cent category. So every price range has that automatic no profit taking under this amount. And I also teach my traders that the moment you take a profit, even if the moment you take a partial profit or the moment you have a right to, you may decide not to. You may get your 80 cents and decide, nah, I'm going to see if I can get more. But you do have a right at 80 cents. So whether you take that right or not, that gives you the right now to go to break even. So your first right to take a profit also is your first right to go to break even. Now that's the direct answer to your question. Your first right to take a profit is your first right to go to break even. You don't go to break even randomly based on how you feel, how you think, what you believe. Your thoughts betray you. Your feelings betray you. Your beliefs betray you. It has to be mechanized. It has to be systemized. You have to become your own algorithm. And so, boom, if your minimum profit is 30 cents, once the stock has moved 30 cents above your entry, you have gained the right to take a partial profit. Whether you exercise that right doesn't make a difference. You have also gained a right to go to break even. Now, let me just elaborate a little bit on what I said initially. The reason why getting in the habit of taking less than 30 cents and getting micro is because if you start taking 20 cents, I promise you, you'll experience things that go to 18 cents and fall back, go to 16 cents and fall back. And then you say, shoot, 20 cents is too much. Then you go to 15 cents. And then the moment you make it 15 cents, you'll experience stocks that move 12 cents and then fall back, move 10 cents and fall back. And you're like, man, nothing moves 15 cents now. Then you'll go from 15 cents to 10, then from 10 to 5. And then you'll start to be satisfied by getting 3, 4, 5, 6 cent moves. And let me tell you, I've been training traders for almost 30 years. I know this. This happens universally. You've got to draw a line in the sand. That line in the sand for my traders is minimum 30 cents. All right. And so you can't move that line, and you have to resist. Even when stocks come up to 28 cents, 29 cents and fall all the way back, you can't start moving that line. You can't make exceptions. The reason is because your losses are always going to be bigger. If you start taking 10-cent gains, I promise you, your average loss is more than 10 cents. It's a losing strategy. Okay? So, draw the line in the sand, and maybe you want to use my thresholds. Under 60 cents, you can go 30 cents. Over 60 cents is 50. Over 100, you start to move to 60. Over 150, you start to move to like 75, 80. All right. And I have my traders create hotkeys for those sell points so that as soon as you get in, boom, you have a hotkey that automatically places your orders at 30 cents, 60 cents, 80 cents, $1. You see? And so you get in the queue early and you're sitting there, and your order sitting there actually psychologically helps you hold on to your gains a little bit longer. Because one serious problem of novice traders is that they hold on to their losses too long, but they snatch away and eliminate their gains too quickly. And just by having your orders in the market ahead of you will psychologically make it easier to say, keep going. There you go. Keep going. And you won't be so prone to snatch at your roses. All right. The typical losing traders letting their weeds grow tall. And as soon as there is even a little small remnant, there's a rose. They snatch the rose out of the ground. And it should be the reverse. You should be snatching your weeds as soon as you recognize them out of the ground and letting your roses flourish. All right. Oliver, is there any way to, VJko is asking, is there any way to predicting elephant bar coming? No, but you can watch it form. Now, this comes down to you should have no more than 10 stocks that you monitor. These are your key stocks. These are your family members. These are your children. And these 10 stocks should be visible on your screen at all times. And so you should be monitoring the active bars of these 10 stocks at all times. And you'll be surprised. You might think that that's a lot, but No, because some won't be monitorable. And maybe at this current moment, 3 are interesting enough to monitor. And so you're watching 3 bars form. And so, as an example, let's say you've narrowed your 10 stocks down to 3 stocks you're going to monitor off the open today, and you're watching 3 bars form. They first all form at the same time with a dash. That's the first transaction. And so one is starting to grow a little bit of green, another starting to grow a little bit of red, and another starting still flat. This green starts to become normal size green. This red stays little. The green stops being normal and starts to become a little bit more than normal. Then it goes from a little bit more to normal to now it's like, wow, boom, there's your elephant. And so as you watch your key stocks form the bar's life, you strike when the bar has achieved what you consider to be an elephant bar. And it sounds complex. It sounds like, oh my God, stressful, but it's really not. It's really not. What would be stressful is if every bar on the chart was moving, but it's really just one bar moving. It's not rocket science. It's not like, have you ever had those screens where you can go to these sites where you can see all the flights in air at the same time, and you see like 15,000 flights moving at the same time. That's complex. 3 bars moving little by little, that's not complex. All right. Ola Lekan. I hope I'm not butchering your guys' names. Oliver, please, how do I overcome the fear of losing? Not FOMO. All right. Not FOMO, meaning not fear of missing out. The fear of losing and FOMO are different, though. So I'm not quite sure I understand that question. How do I overcome the fear of losing and not FOMO in after? I think that's what the question is. The trick that I have used sometimes on traders is to play the losing game. If you're suffering from chronic fear of losing, all right, you're crippled because you're scared this is going to just be another losing trade. You have to find a way to make losing okay. So the way I've turned traders around with this is to make losing the objective. So sometimes we do it for an entire day. Sometimes we do it for a period of a day. And sometimes we do it for just one trade. So as an example, on this trade, all right, your job is to lose. But now, not just lose. Your job is to lose exactly 49 cents in the trade. So if you buy at 40, you need to lose at $39, right? And 51 cents exactly. If you short, stock has to go up 49 cents. You got to get out exactly at 49, not 50 cents, not 48 cents. I want you to pinpoint a 49-cent loss. Now go find one. And by changing the objective from, and when I do this drill, the traders are like, ha, 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 Oliver, I have no problem with that. I'm going to be an expert at this because I always lose. And I said, okay, well, show me. And so when I make the objective losing, guess what starts to happen? Guess what they realize? Holy, I'm winning. And I'm like, look at that. See, you can't even lose right. But what this does is it flips the mindset upside down. And it changes the neural pathways and it shakes things up a little bit. In addition to that, it builds an incredible skill because imagine the skill it takes to, number one, find something that's going to go opposite of your trade. So you have to find something that you believe is going to go opposite of your action, your buy or your sell. And then you have to have the timing enough the execution skills, the timing, the precision. Boom. Now, I make this drill sometimes overly complex by having them do it with a certain number of shares. So 2 lots, so 200 shares, and you can only trade, you only got 2 ways to exit. You can exit all of the 200 shares for your 49-cent loss, or you can exit them separately. 100 now, and then ease that last 100 in, all right, to get a certain specific loss. But this brings in all of the qualities of being a precision-based trader. Sometimes if you flip something upside down, magic happens. Sometimes when you flip a chart upside down, you get an epiphany. Sometimes when you make the objective to lose properly, not to win, you get an epiphany. You understand? Sometimes when you stop, stand still, stop moving, and turn around, you see life from a different perspective. And so you need that interrupt every now and then, you know? I call them interrupts. You need these shakeups. You need those interrupts to break you out of these repetitive modes. And so that's one way, okay? You got to find a way to convince yourself that it's losing properly that is the key to winning. It is not winning that is the key to winning in this game, traders. You can't win your way to winning. You lose your way to winning. Respect your losses. Honor your losses. Honor the craft, the skill, the art of losing properly. Winning is lucky, but losing properly is skillful. That's not, you can't lose properly and be lucky, but you can win and be lucky. So honor losses. You shouldn't fear them, honor them, practice them, become an expert loser. I promise you the market will take care of the winners. I promise you. Stocks will go up all by themselves. They don't need your help. What needs your help is losses. Losses can't stop themselves. The losses need your help, right? So if you become a master loser, the market will appreciate that and take care of you on the winning side. All right. Last question, guys, I got to take, but this is great, right? I'm going to do these regularly. I promise you. I promise you. When to consider buying hardware wallet for Bitcoin? My general rule is 3 times the value of the hardware wallet of your choice. So if your hardware wallet is $50 and you have assets that are 150 or more, it's time. Okay. So 3 times the value of the wallet of your choice. So go pick a wallet. All right. I like, for Bitcoin, I like Cold Card, Trezor, Ledger. All right. There's also the new green wallet that's out today, which I'm experimenting or what have you. But I would say my top 3 are Cold Card, Trezor, and Ledger, and actually in that order. Your Trezor and Ledger will hold more assets than Bitcoin. Cold Card is just strictly a Bitcoin hard wallet. Now, get the price of that. Pick one, get the price, and wait until you're 3 times, you have assets that you want to hold, not that you want to trade in and out of. If you're trading in and out of, it doesn't make sense to move it to cold storage, right? But if you say, no, I'm storing my value here for a while, you're going to move that off exchange. And once the amount that you want to store and lock away, all right, is 3 times the value of the wallet that you want, it's time to move that. All right, because in reality, all you have when your assets are on exchange is an IOU. And we're full of history where the IOUs have been taken, hacked, confiscated, mistakes have been made with it. I just want it in my possession. Okay? And so you don't really own it, truthfully, unless you have the key. And when you keep your value in the hands of someone else. Okay? What you're really doing is saying, look, I have the value that I've given my life up for. I have gone out into the world and I have exchanged my energy, my life, my skill, my talent, the crowning jewel of who I am. I've exchanged who I am, and in exchange for this, in exchange for giving me, I receive value. This value I am giving to you. This is what you're saying when you keep your assets on exchange. I am transferring my essence into this item and I'm letting you hold it in your safe. I don't have the key. It's your safe. You have the key. Keep it for me. Now, most of you would not do that in real life, would you? Say, just keep it in your safe. I don't even have the key to it. I don't even have the combination. Just keep it for me. If you wouldn't do that in real life, why are you doing it now? Bitcoin in particular has come into existence as the first asset that gives everyone the ability to self-custody. You couldn't self-custody your stocks. You couldn't self-custody your bonds. Well, in the bearer bond days, you could. But bearer bonds were made illegal. So here's the first asset in a long time where you get the ability to self-custody. You used to be able to self-custody gold, but they made gold ownership illegal for decades to self-custody, right? So I don't want my value in someone else's vault where they have the combination. Not happening. Not happening with me. All right? Not if I have the ability to hold it. Now, it takes some responsibility to do this, but it also takes just as much responsibility to protect yourself when the asset is on exchange. Because how many people have you heard lost their crypto assets while being on the exchange? Millions of people. You know, if you've got two-factor authentication, if you've got your assets on exchange and you protect that, I've got two-factor authorization, yay, I'm protected. And that's two-factor authorization with your telephone number, with your cell number. That might as well be a welcome sign to get your assets stolen. That's the number one way people think they're correct, they're protected. They've got assets on a Coinbase, they've got two-factor authentication linked to a text that goes to their cell phone. And that's the number one way people get their assets taken, because if someone hacks your email, they can gain access to your telephone account. And if they can convince someone at the telephone company that they're you, they can get a new SIM card. And now everything goes to them. And I've heard hundreds of scenarios where SIM card hacks have happened. It's probably the number one way people lose their assets. It's not Coinbase's fault. It's not Binance's fault. It's your fault. It's your fault for having two-factor authentication on a text, number one. It's your fault for not protecting yourself. You should not be using a Gmail. You should not be using a Yahoo, a Hotmail, number one. All right? You should not be leaving your assets on exchange if you have significant amounts that you're planning on holding. All right? And so all of these things I talk about with my traders, guys. I want them safe. I want them protected. I want them doing the right thing. And remember what I told you. I want them building the right experiences. You are nothing more than the collection of all of the experiences you've had. And if you don't like that, you can change it starting today. You can change the quality of experiences you start to accumulate. And so part of my job is to help you acquire the right experiences so that your future tomorrow, after you've accumulated enough of these new experiences, correct experiences, your future tomorrow is brighter, your future tomorrow is better. And as a result, your future you is better. God bless you, traders. Thank you so much for showing up. Short notice, no notice, impromptu. This is very impressive. All right. I love you all. All right. Enjoy the rest of your weekend. We're back at the equity game on Monday morning. And of course, you know, Bitcoin never sleeps. All right. So we're always in that game. Ciao for now, guys. Love you to death. Boom. Yeah.